Hey guys, welcome back to the channel. I want to talk today about what is the most dangerous factor in your trading, always the most dangerous factor, and the main thing that will blow your accounts. Um, and just to get it out there, I've talked about this before, it is and always will be leverage. Leverage is extremely dangerous. It's not taking the wrong entry, it's not the price moving against you, it's none of those things, it's leverage. Leverage is the beast that you have to avoid. So as an example, I'm going to look today at a signal, a copy service called NCM. And my trading partner and I are always studying other signals, other trade copiers, other EAs, other people's trading to try to learn. Because not only can we learn things that we don't know by watching other people's trading before we have to learn those lessons the hard way, but sometimes you've learned something and you kind of forget it. It's not at the forefront of your thoughts anymore. And by watching other people's signals or trading or copying or EAs, you bring those things back to the forefront of your thoughts so that you can keep them in mind consistently. So we're always watching other traders, and one that we've watched for a while and have generally liked is this NCM signal. NCM conservative is the name of the signal. So if we look at what this company's doing, they talk about how consistent and stable they are. 1,269 days running, 500% gain, 60% annual gain. It's a Forex copy service. They talk about their latency, which is very low, but honestly, that's silly. Latency is almost never a problem in trading. Having waiting an extra 300 milliseconds to place your trade is not going to make a difference in most systems, unless it's a very, very specialized high-speed type of system that really requires that. Maybe for some kind of high-speed trading or some trading where you're trying to compare prices between brokers and quickly take a trade on a second broker because the price is better than a first broker or something like that. Or maybe in some scalping systems, although even with those, it's usually not a big deal. People focus way too much on latency in trading, in my opinion, because for most traders and most systems, the latency is not an important factor. So they talk about their latency, and then they talk about their verified and transparent results. I agree, they are verified and transparent. That's great. And they show you here how you can, what kind of money you can make if you take more risk, less risk. One of the things I've experienced with signals and copy services is that a lot of traders, or many traders, probably even most traders, are not happy to take the risk of the signal. They want to multiply it because they're greedy. They want to make money more quickly. They don't see the risk coming, and there's always risk in trading. We all know that, hopefully. But so they multiply it, double it, triple it, etc., to try to make more money more quickly. That is, I could say, always is a strong word, and I don't like to use the word always, but almost always a bad idea to multiply any signal. Here we can see some testimonials. Joined 6 months ago, the most stable signal I've ever tried, no sleepless nights. They're extremely risk aware. My account is safe. Investing in substantial account safety is important. Good, safe job. Low signal fee, quite stable. 5 months, very reliable. Low drawdown. So anyway, very good reviews. So if we want to look at the system, let's take a look at that. Their page is loading here. You can trust in our system. It's created with the aim of providing quality service for investors. One of the most important aspects is to be able to provide a sustainable profit in the long term for our clients with the lowest risk exposure. So they talk about their trading strategy, which they say is a light grid martingale. They talk about their 81% success rate. Now, usually that's not a good way to measure a system in most cases, and they probably have 81% of their trades in profit. But with any grid, and especially with any grid, chances are you're going to have that type of success rate because you don't close the grid until your overall grid is in profit, which generally means that most of your trades on the grid will be in profit. So I would, probably ignore that, although I guess there could be other arguments there, but generally speaking, that doesn't mean much. They control the risk. If you just take our risk, you can get a 60% annual gain. If you take a value of 200, you'll get double the profit but double the risk. protect your capital, quality standards, etc. So that's their system. Subscribe. You can subscribe for, I think, oh, and there's the MyFX book here, which I've already opened and we'll look at in a second. $39 a month for a subscription, and I think that's all we really need to say there. So if we just take a look at their signal on MyFX book, you can see that it's been trading since February 4th of 2018. And if we look at, let's just do some custom analysis, and let's just say we take from the beginning of the signal until maybe the beginning of July. We'll analyze it. Waiting for my FX book to load. We can see here, well, let's go a little bit earlier. Hold on. Let's go slightly earlier. So we'll go to the end of June somewhere. June 26th will do. Okay. So you can see they've been making about 4.5% a month with a 15% drawdown. Very respectable, very reasonable, and a long track history, a track record here with 1,239 trades, making about 4 pips a trade, which is good. Average trade length 4 hours, that's good. So really, the metrics are pretty good here. Let me refresh this page to get back to the original metrics. So remember that 15% drawdown, because the drawdown is very different now. So if we look at the drawdown now, it's 44.5% drawdown with a 4.35% a month gain, which is not nearly as good as that 15% drawdown to a 4.5% gain. When I looked at this signal in the past, my trade partner and I looked at it, we thought, oh, this is a pretty reasonable signal, looks pretty good. But of course, we want to watch it, see what it's doing, learn from it. What you can see is that they opened a grid on GBP CAD on July 5th with 0.07 lots. And before we look at that, let's just check the account size. Account balance of $17.99. Currently, the equity is about $1,000. And we can see that they've got 0.43 lots opened on this grid. So they opened on the 5th of June, 6th of July, 6th of July, 6th of July, 22nd of July, and now they started the martingale on the 27th of July. So currently they have 0.43 lots. And if we look here at the exposure tab, we can see that 0.43 lots with an average price of 1.7268. So if we look at this on, let's see, on TradingView, I had this loaded up for you guys, but it looks like their ad has come in and kind of messed up my view. So let me reload this for you. We're on the let's go to the 4-hour chart on GBP CAD, and they entered their position somewhere right around, I believe, right around here. That's when they entered. And then the price that they entered at, if we just take a look at that, open trades, they entered at 1.70899. So 1.70899, let's mark that. 1.70. Right around here is where they opened this level. And the average price we can see is around 1.7268. So let's go mark that. 1.7268. There we go. So this is their average price on their grid, and this is where they opened the grid near the beginning of July. As you can see, the price has gone up, done a retrace, and then continued up. Now that they're martingaling, let's see where they stand. So this is 0.43 GBP CAD lots, and the Great British Pound to the US dollar is somewhere around 1.3. So we need to multiply this, since they're buying 100,000 Great British pounds, that's like buying 130,000 US dollars. So we need to multiply the lot size by about 1.3. And when we do that, we get something in the neighborhood of 0. What is 30% of that? I don't know, 0.54 something. Let me get my calculator out. I'll pause the video for you guys and I'll calculate it. Okay, so it's around 0.56 lots of US dollar. And so that means they own about 56,000 US dollars if we convert it. And you can see that their equity is around $1,000. So they're a little under $1,000. So they're approaching 60 to 1 leverage here. And you know, I think we've talked about this in the past. 60 to 1 leverage is a dangerous leverage, because the problem with leverage is that at first it increases very slowly, but it's based on your account equity. So as your position size increases, as you add to your lot sizing, and your equity drops as you go into drawdown, leverage trends against you faster and faster and faster. So you start out, 1 pip might increase your leverage very little, because you have a big equity and you have a small number of lots. But as you increase the number of lots and as you go into drawdown and your equity gets smaller, 1 pip hurts you a lot, because suddenly instead of trading 0.07 lots, you're now trading 0.43 lots, and when 1 pip move occurs, that's a huge impact. And not only that, instead of having an $1,800 equity, you now have less than $1,000 equity, and rapidly decreasing as the price moves against you. So how much has the price moved against them? Well, if we calculate it out, and I did that before I started this video, my trade partner and I looked at it earlier, the currency has moved about 2.47% against them, which is really, on a currency like this, not that big of a move. I mean, you might see this currency move, 3 or 4% against you, or maybe even more. So it's only gone about 2.5% against them. And they're already in a position where they're approaching 60 to 1 equity, and they're at 45% drawdown. Let me tell you guys, that is an extremely dangerous position to be in. And, this seemingly safe signal that we saw run since February of 2018 is now in huge risk. And imagine if you're a customer of them who has increased your risk to, let's say, double, for example. You've taken double the risk. You could be on your way out with this signal, completely crashed out, margin call from your broker, and lost all your funds. So at this point, just a few pips move in this currency, because of the extremely high leverage, and because they've started the martingale and they haven't closed any positions. This, it could come back, but it's all about luck now. If the currency moves a little bit more against them, then they can crash out the entire account. Or if they're lucky and the currency goes their way at this point, which it may or may not, if it goes their way, they could come out clean. They could come out fine. But it's we saw in the testimonials that there are people with a lot of money invested here. This signal provider is only risking $1,000 at this point. So they don't care. They're going to hold it. They're going to hold this position most likely, and they're not willing to take any kind of a haircut here, any kind of a loss, to make the position safer. So they're risking $1,000, but there could be investors who came into this thinking it's very safe, it's a solid investment, it's very stable, I can sleep at night, that are now risking $50,000 or $100,000, big amounts of money. It's easy for the signal provider to take this risk, but the investors are at this point in extreme danger, because a little bit of move more in this currency could crash out and lose everything that they've invested. So in my opinion, at this point, the right thing to do as this signal provider, what they should be doing is closing these positions. Maybe not close them all, but I don't think it's a time to martingale when you're at 60 to 1 leverage. It's not safe to martingale at this time. So some of these positions really need to be closed. Some haircut needs to be taken. Some loss needs to be taken to preserve capital. But you can see that's probably not going to happen here. The signal provider doesn't want to lose clients, so they're going to continue to let this ride, take a gamble with their $1,000 and with their investors potentially tens or hundreds of thousands of dollars. Take a gamble that things are going to go back in their direction with the price, and that may happen, but it may not. So you always have to calculate your leverage. You always have to watch your leverage. If you're going to invest real money in trading, if you're going to invest big money, you have to be willing to take a loss in a situation like this, in my opinion. This is not the kind of situation where you want to throw the dice and hope that you come out clean. This is the kind of situation where emergency measures are called for. You need to take some losses, and you need to think about preserving your capital, not about keeping a clean shirt for your investors. So, thought you guys would be interested in this extremely dangerous situation for what had previously been a super stable looking signal. It'll be interesting to watch how this provider goes through this. And as I said, they could come out of this completely clean, but there's also a chance they lose everything here. This is a very dangerous situation with already 60 to 1 leverage. Anytime you go above about a 30 to 1 leverage, it's starting to get dangerous. Anytime you're at a 60 to 1 leverage, it's like a roller coaster. It could go down the hill very, very quickly. Hope you guys enjoyed the video, and look forward to talking to you on the next video. Thanks.